Welcome everyone to the AAT Level 4 Synoptic session, part 2. So in this session, we're going to start from task number 4. So we have done task 1, 2, and 3 on our previous session. And in this session, we're going to practice from task 4. As I said, before we start the question, we always read the requirement so that we understand what exactly the question looking for. So we can see this task 4 give us some sort of calculation question. They said for each of the product calculated the marginal cost and annual contribution that would be earned at each of the three price as Cynthia has considered. Okay. So after that, they said select the price that would give the highest contribution to profit for each of the two product. All right. And after that, they said discuss the potential impact of Louis Harding proposal policy of the business for 5 marks. So you understand we have to calculate few things. The first thing we have to calculate that is marginal cost per unit. Now marginal cost per unit means only the variable cost, only the variable cost, only the variable cost. So marginal cost means only the variable cost. And after that, we have to calculate the contribution, but annual contribution, that means yearly contribution, not for one product, not for 1 month, for the whole year contribution. So for that, I have to know how much is the contribution for one product and how many unit I can sell for the whole year. For example, let's say the contribution for NP1 is £1, and if I can sell 100 unit for the whole year, so my total contribution will be 100. All right, so let's read the question now. We understand what is the requirement. Let's read the question. Says review of the product pricing. The latest annual result of SL Product Limited have confirmed that trend of decline in the gross profit margin. The board of directors has asked Cynthia Moss, sales director, and the Louis Harding, finance director, to review the situation and report back with agreed proposal. The company operates in a very competitive and high-tech market. It is necessary to create a stream of innovative new products that are good as or better than or those marketed by the competitors. Meanwhile, older products rapidly go into decline. It is almost impossible to increase the price of a product after it is launched. Lewis proposed that all new products should be priced to give 30% markup over cost. Now this question we have in the bottom. They said what do you think about the Lewis proposal, so you can make some note for that. He said every single product we're going to sell we will make a profit 30%, so markup over cost. So whatever is the cost, I'm going to add 30% top of that so that I can find the selling price. For example, if my cost is 100, I'm going to add another 30 as a profit, so my selling price will be 130. We only get one chance to get the price right. Production costs are always rising, but we cannot increase our prices. If we launch the product with a 30% markup, they will be profitable for the year. So this is a good thing. If you add 30% markup with the product, your product will be profitable, no doubt. But at the same times, we have a good side and the bad side both. At the same times, maybe in the market people are not paying this price. Maybe you are set up the price 130 for one unit, but in the market they can buy it for 100 unit and people are not willing to pay this money. So obviously if this is the situation, then obviously it doesn't make any sense if you set up any price and if the customer not willing to pay it. So this is the disadvantage. So you're going to talk both sides. We're going to say what is the advantage of the 30% markup and what is the potential disadvantage of that. So the chief accountant has created a simple spreadsheet model to determine the selling price for new product. She has used this model to calculate the selling price of two new products that are ready to launch. So you have a two new product, NP1 and NP2. Pricing spreadsheet Sue explained that this is a full overhead recovery pricing model. The variable element of production overhead is equal to 15% of the direct cost. So inside of the production overhead, we have some variable and we have some fixed. So the variable amount is 15% of the direct cost. So direct cost we have 15% is the variable. The direct costs are all variables, so all these direct costs are variable, and from here it is 15% variable. Marketing and admin costs are fixed, so these are fixed. Okay, then after that we have some more information. Let's have a look what is the more information we have. So they said the sales director response, Cynthia says that the spreadsheet price are not competitive. She knows that the business will suffer if she cannot refresh the product range with a new product at attractive price. She has compared each of the two products, NP1 and NP2, with the competitor's product and has estimated that sales potential at three price level. So you have NP1 and NP2 price level and estimated annual volume to undercut competition. That's the price. So if I try to undercut the competition, so the price has to be 21 pound and I can sell 250 unit, and NP2 52 is 600 unit. Market price in the market, the currently the price is 28, and this can sell up to 150. And for NP2, the market price for one unit is 60 and they can sell for 400 volume. That's the unit. The spreadsheet price, the price we propose with the 30% markup, that is 35 pound, that is quite higher than the market price. So because the price is high, we can see the volume is down, so only 50 people, like 50 unit we can sell for the whole year. And for NP2, if I keep the price 81.90, so only I can sell 150 for the whole year. The above information can also be seen. So any of the information, if I like to see, if I click, I can see it here. For example, if I like to see this one, spreadsheet pricing, I can see it here. So it will show me what is the spreadsheet pricing. All right, so let's have a look. What is the other information we have? And now we have to calculate our markup. And after that, we need to choose which one is the best one, like which one gave the more profit. So that should not be a problem. So calculate the marginal cost per unit. So marginal cost means only the variable cost. So let's open this one to see the information. So we said pricing the product. So this is our information. We can see that, but we don't need it. We want to calculate the spreadsheet price. So let's have a look. So we said how much will be the marginal cost for NP1 and NP2. So let's have a look. NP1 and NP2. So we have a direct material. The question said direct costs are all variable. So all the direct costs are variable. So direct cost. So let's have a look. So direct cost is 18 and 42. Then the production overhead, they said 15% is variable. So 15% of 18, so that will be variable. So let's have a look. How much is the 15% of the 18? So 18 times 15%, and that gives me 2.7. So 2.7, and this gives me 15% of 42. This gives me 6.3. So that's my total variable cost. And if I added this to 18 plus 2.7, this gives me 20.70. And if I added 42 plus 6.3, that gives me 48.30. 48.30. So that's my marginal cost. So we're going to write this one 20.70 and 48.30. All right, so this is our first requirement is done. Now they said what will be the contribution. To find the contribution, we have to find how much is the contribution per unit, isn't it? So we have a three price range on the spreadsheet. So let's have a look. What is the three price range? So let's open this one. So on the sales director response, so they said we can only sell up to, can keep it here or maybe in the top. Yeah. So they said we can sell only 150 50 for that. So they're asking for everyone, isn't it? So they're asking for the what is the undercut, the competition, and the market price spreadsheet, the total uh, contribution. So let's find the contribution per unit first. So my selling price will be 21 for undercut competition. So I'm going to write undercut competition. So that will give me my selling price 21. So 21 minus 20.70. So the difference will be 30 pence. So my contribution will be 30 pence if I choose this one, undercut competition price. So 21 minus 20.70, this gives me the contribution 30 pence. And for this one, 52 minus 48.30, that will give me 3.70. Then for the market price, 28 minus 20.70, that will give me 7.30. And 60 minus 48.30, if I follow the market price, my contribution will be 11.70. And finally, the spreadsheet price, the proposed price, if I keep the market price 35.10, this gives me contribution 14.40. And for the NP2, 33.60. That's my contribution per unit. But the question said annual contributions for the whole year. So you have to multiply with the number of unit. For the whole year, we can sell 250 if I go for the undercut. So I said 0.30 times 250, that gives me 75. So 75 will be my contribution if I go for the undercut. So I'm going to say 75. And then if I follow this one, the NP2, so this is 3.70 per unit. So for the 600 unit, it will give me 2220 22220. Then the market price, if I follow the market price, 7.30 times the demand is 150, that gives me 1095, and this gives me 4680, and the spreadsheet price gives me 720 and 5040. So that's how we can see how much is the total contribution for the whole year. So then after that, they said select the price that give you the highest contribution. So we can see this one for the NP1. For the NP1, the market price give me the higher contribution. And for the NP2, the spreadsheet price give me the higher contribution. So I said for NP1, the market price will give me the higher contribution. And for the NP2, the spreadsheet price will give me the higher contribution. So this is the calculation for this question. That's not very difficult. So should be fine for all of us. All right, let's move to the next requirement. The next requirement is said what we think about the proposal of this guy. So let's have a look. What is the proposal we had before? So he said put 30% markup on every single product so that we can have more profit. So the first thing we have first we need to write the good side. We'll say any price that is higher than the marginal cost will contribute and increase the profit. So any price higher than marginal cost will increase contribution and will increase profit. So any cost, if any price that is higher than the marginal cost, that will increase the contribution. So for example, if my sales price is higher than the marginal cost, so my contribution will be higher and my profit will be higher. And obviously, we need to also consider how much we can sell. That's the problem. So the bad side is if the price is not competitive, if the price is not competitive, it may lose the customer and sales volume. So if we don't change the price, if we keep the price higher, maybe the sales will not be expected, the sales volume will go down, and also that we maybe lose the customer. So you have to make sure we have to keep the price competitive unless our product is a really unique or there is something new involved that on our product this one is not in the market. So the product has to be unique, and this market is so competitive, so you have to always look for the new innovation to the product so that we can introduce the new product in the market. You can write some more what if you like. For example, you can say SPL is in a price competitive business. Then if the product are not priced competitively, they will sell in a small volume. Then if the product is old, they will be declined very soon. So you can write all of this if you like. All right, so this is the end of the question. So let's move on to the next question. We have task 1.5. So in this question, task 5, we have to calculate the ratio analysis, and after that maybe we have to do some other interpretation or analysis based on the question requirement. So let's read this question. Says Louise Harding, the finance director, is preparing a presentation for the board of directors. She has asked you to complete a comparative scorecard of key financial ratio which she will use as a part of the presentation. Relevant data has been extracted from the last 2 years account. This extract do not include the result of Marvel Limited. So Marvel is basically the subsidiary of the SP Limited, SL Limited. So let's have a look. This is the data. This is for the last year ended 31st of December 2011, and year ended 31st of December 2012. So we have a sales revenue, we have a cost of sales, profit for the operation, we have asset and liability, all of this. So let's look at the question we have here. This says complete the scorecard by calculating the missing ratios. Ratios is quite easy and interesting. So it's not something is a very difficult. All you have to remember some formula of the ratio, and that will be absolutely fine to get a good mark in the exam. So let's have a look. What is the formula we have to remember? Here we have a gross profit. So gross profit, it means gross profit divided sell. So gross profit divided sales. Then we have a return on capital employed. That is the return on capital employed. That means we have a profit from the operation. So profit over capital employed. So capital employed means total asset we have from the question, and after that we have to minus the current liability. So total asset minus current liability will give us the return on capital employed. So total asset minus current liability will give us the capital employed. So let's have a look this one, how much we have the profit. So you can see the profit from the operation is 470, and from here we can see the total asset we have 11,180, and we have to minus the non-current liability. So that is this 3730 minus 260 minus 240, that gives me 6950. So 470 divide 6950, that gives me the return on capital employed. So 6.76%. Anyway, so we're going to see all this anyway. So let's move on. So the next point we have here after the return on capital employed. So we have a gearing, but they didn't ask anything for the gearing. Then we have a current ratio. So current ratio, the formula is current asset divide current liability. So current asset divide current liability. Then we have acid test, or the quick ratio is the same exactly like the current ratio, but this time the inventory will not be included here. So current asset, but this time no inventory. No inventory divide current liabilities. And after that, we have a working capital cycle. Working capital cycle means inventory holding period plus the trade payable minus the trade payable. So we have inventory plus the trade receivables and minus the trade payable. This is basically the working capital cycle. That means how quickly you paid the money. So do you give more time to your customer to pay to you, or you take more time to pay your supplier? So this is called working capital cycle. All right, so it's not very difficult. Let's have a look. How can we solve this problem? So the first thing we need to know about the gross profit. Now we can see here we have a sales and we have a cost of sales. So sales minus cost of sales, that will give me the gross profit. So let's do this one. 20,900 is the sales minus 15,144. So this one gave me 5, 7, and 5, 6. That's my gross profit, and the sales is 20,900. So times by 100, that will give me the gross profit margin. So divide by 20,900, that gives me 27.5%. 27.5%. So that's my gross profit margin. The next one, return on capital employed. So we have already seen that. So our return is 470. So I'm going to write 470. That's my return. And on the bottom, I'm going to write the capital employed. The capital employed means total asset minus current liability. So my total asset, we can see 11,180, this one, and minus the current liability, this 3. So we have a minus 3730, minus 260, and 240. So 3730 minus 260 minus 240. So 470, and it will give me 6950 times 100%, and it will give me 6.76. So I can say 6.8%. And the next one, we have the current asset divide current liability. So we have a current asset, that is this 3. So I'm going to say the current ratio is current asset divide current liability. So the current asset, we have 3908 plus 3032 plus 6. So my current asset, we have 6946, and the current liability, we have 3730 plus 260 plus 240. That gives me 4230. So 6946 divide 4259. That gives me 1.6. 1.6 to 1. And the quick ratio, this time I'm going to minus the inventory. So 6946 minus the inventory 3908. 3908. And the current liability is same anyway. So 59. So that will give me 6946 minus 3908 divide 4259, and this gives me 0.7. 0.7 is to 1. I think this is the workings. So after that, we can complete this one. So we can say, let's complete this one, remove a little bit from here. Okay. So we have now this one. We're going to say the gross profit 27.5%, return on capital employed 6.8%, current ratio 1.6, and the acid test or the quick ratio 0.7. And the working capital is quite easy, so we need to add 94 plus 53 minus 90. That gives me 57 days. That's it. So it will give you easy 10 marks. It's not very difficult at all. All of us should get the full marks on the ratio analysis question. All right, let's move on. What is the next part? The interpretation part. This will be a little bit tricky. Let's have a look. We can solve it or not. Say the profitability. Uh, Select the one correct observation about each of the aspect of the business performance below. So what does that mean? The profitability. They said this has been a year steady, if spectacular progress, although profitability has dipped. The return on capital employed has been kept under control. That's not true, isn't it? We can see our return on capital employed is going down. It was 17.5% last year, and this year 6.8. Last year the gross profit was 28, this time 27. So it's not true. It's not the right one. The profitability ratio gives cause for concern. It is concern exactly because the profitability is going down. The small increase in sales has not improved the gross profit margin. Operating expense has increased, reducing the operating profit on return on company. That's absolutely true. Even though there is a little bit increase of the sales amount, so you can see the sales was last year 20, this year 20,900, but it have no impact overall on the profit. So this is the right one. Then we have the gearing. Gearing means debt divided equity. So if I borrow a lot of money from the business, my gearing will be high. So high gear is not good for the company. Even the low gear is not very good for the company. So it should have a balance. The increased gearing ratio is entirely due to increased non-current asset. Then we have it is likely that the interest cover ratio has increased. The increased gearing ratio show the company become more risky. So the first one obviously is not true. Then the next one is not true. And if the gearing is high, company is more risky because if you take a lot of loan from the bank or from the third party, you have to pay it back. So if the company have a more debt or more loan, that means the company have a high gearing. So high gearing is not good for the company. So it will be more risky. Liquidity is a link with the current ratio and the quick ratio. So they said both ratio have Detroit, which indicate that company is a less solvent. That's true because my current ratio and the quick ratio both are reduced. You can see here it was 1.8, now 1.6. It was 0.8, now 0.7. So both are reduced. So that means the company is less solvent. Liquidity ratio only deal with the liquid cash for the business. So how much liquid the company is, you can get it from the liquidity ratio. Then working capital is means how long it take, how long I can hold the money in my business. So the working capital will be good if I pay to my supplier late and if I collect the money from my customer really quick. So it's better if I can hold the money to my supplier long and I quick collect the money quickly from my customer, then my working capital will be improved. So working capital is decreased. Before it was 60 days, now it is 57 days, so it is better now. So we can say the working capital cycle has odds. No, it's not odds, it's not bad. There is a welcome improvement in the working capital cycle, mainly due to changes in the payment period of the payable. That's true. So it's welcoming because before that it was 60 days, now it is 57 days. If it is decrease, it is good for us because working capital cycle is not something I want more and more. I want less. More or less it is good for me. So I'll say it is a decrease. So I have improved my working capital cycle. Finally, we have the last one, overall performance. Profitability has declined in 2002, mainly due to competitive pressure. However, the gearing and the liquidity measures show improve. No, the liquidity and gearing is not improving, is both are going down. 2012 has been a bad year, so this year is a bad year. Profitability has declined. Finance are coming under pressure. That's true, because this year my profitability is declined. Steady progress. It's not a steady progress because it's going down. This is the end of the question. So this question is quite straightforward and not very difficult. I'm sure all of us we can get like whole 15 marks, 20 marks from this question. So make a good preparation on the ratio analysis. Hopefully, we'll get a good score in this question, task 5. So we'll finish our video today here. So hopefully the task 1.6 maybe we'll discuss maybe in any other videos, and hopefully like we understand now task 1.4 and 5 for this level 4 synoptics. If you have any question, you can email me. You have my email on the description. And thank you everyone for watching the video.